everybody. Welcome to another episode of 10,000 Roads to Financial Independence. Today, I have Veena Jetti. Veena is a founding member of Vive Funds, a unique commercial real estate firm that specializes in curating conservative opportunities for investors. It has a vision of an investor-centric firm coupled with proven best practices coming together. The firm was established to create a space for investors to rely on carefully planned projects with client experience being at the forefront of our mission. And a project with Vive name on it can be trusted to have gone through vigorous vetting. Veena brings a dynamic perspective to targeting, acquiring, managing, and operating assets using best practice combined with cutting-edge technologies. Her professional expertise includes driving corporation strategy and business development opportunities. But aside from here, just kind of share a little offhand, Veena is also currently in charge of over $500 million with a B AMU of multifamily investments. She's has also various appearances over conference, podcast, global conference, and radio shows. And she's a very avid blogger, also writes a lot of articles on Forbes. Veena also, aside from professional endeavor, she's passionate philanthropist. She has founded and served on board of an international nonprofit organization involved in many organizations such as ripmedicaldebt.org, local food banks, water.org, St. Jude Hospitals, Children's Hospitals of Philadelphia, and Safe Mother, Safe Baby, and Kiva.org. So lots of involvement, lots of good stuff over there. She's very passionate about her philanthropist journey. In 2017, she was one of the only 3 women to receive the Political Woman of the Year award for a significant amount of time and the focus she spent on aiding grassroots Hurricane Harvey disaster response. So welcome to our show, Veena. There's a whole bunch of rap sheets over here for you, and we're very excited to have you on our show.
Thank you. I'm excited to be here.
Awesome. So Veena is really someone that I look up to, when I have some questions on next level growth that I kind of turn to, and then she was really generous with her time. We always start our show asking our guests this question, which is thinking back in your childhood, who or what incidents kind of shaped the entrepreneur who you are today?
Yeah, I think easily if I have to look to one person, it's my mom. So she's actually a successful real estate investor herself. So I grew up, like I always joke and say, like, I kind of took the shortcut in because my mom always invested for our family. My dad had the traditional W-2 job, and my mom was really the one who immigrated to this country. They're like the classic immigration story. They had no money. They came with $26 and they built everything from the ground up with a lot of hard work, a lot of smart decisions, and a little bit of luck. So my mom's really the one who shaped me into being the investor that I am. And I think both of my parents were really influential on letting me hone the skills that I needed to do what I do today. They, raised my sister and I both to be really confident and to take risks and they raised us to believe we could do anything. So we're trying it.
Yeah, that's amazing, because I think a lot of great women entrepreneurs that met interviewed on our show, I think a lot of kind of roots into seeing that role model example of their mother, usually a strong female figure in their life. This is really exciting. So Veena, tell us a little bit more about kind of your transition, graduating from University of Chicago, I believe.
University of Illinois, yep.
Yeah, Illinois, sorry. University of Illinois, and kind of ranking through the ranks, raising through the ranks, and now become the owner of your own company. How is that journal kind of pulled it out?
Yeah, so like you said, I graduated from the University of Illinois. I was 20 years old. I got my degree in finance. I think that my mom was really, excited. She's like, now you can come, help with the family business. And, I was 20, so I knew everything. And I was like, no, I have a degree. I'm going to go out into the world and do something amazing and totally different without, the help of the family. And So I got a job in corporate real estate and ultimately I made a lot of money for somebody else and really felt the pain of that the first year that my husband and I were married and paid taxes jointly.
Mhm.
And I was at Tishman at the time, Tishman Spire in DC. I had $1 billion asset that I was on the management team for. And I called my mom and was like, hey, mom, like, here's what just happened. What do we do? And that's when she really encouraged me to start investing for ourselves and kind of following in her footsteps. So that was back in 2012. So I left the corporate world and started investing into real estate, which we keep leveling up, if you will. We keep going after bigger and bigger deals. Another person that I would say is like influential in my life today is Ellie, who's one of my JV partners, and who you know as well. She's a phenomenal woman, very smart. I learned so much from her, and just seeing her grow has been such a pleasure. And so now we have assets we're going after together. Our most recent close was a $78 million deal. And prior to that, it was an $80 million deal. So we've kind of grown and we've set
Wow.
the tone of where we want to be.
Yeah. It's a very competitive at that level because you're competing with the institutional, REIT funds and et cetera.
Yes.
Yeah. So tell us a little bit more, in 2012, but like you mentioned about, hey, you quit your corporation job and start investing. Tell us a little more about that transition. Like what kind of lead up to it? Did you kind of quit cold turkey right away? And how do you actually support, or if there's any fears and concerns on supporting lifestyles and et cetera to do the transition?
Yeah, there was no transition. It was kind of I mean, obviously I gave them notice, so I had plenty of transition time out of the company, but the time I actually put in my resignation, from the time I made the decision to the time I did it, I might have been even like days or the same,
Wow.
like, yeah, it was not very long. But I also had the benefit too of being married to someone who is a high income earner. And so I had a pretty solid safety net. Although I will say, like, my backup plan was like, we'll just move back in with my parents and it'll be great. And I don't think my parents thought that was the backup plan, but I totally did. um, so, we, at some point, you just have to take a leap of faith, right? And I think sometimes, especially if you don't have that kind of safety net, it can be a lot scarier and a lot more difficult, rightfully so. But if you're hungry, you're going to figure out how to eat, right? And that's what being an entrepreneur really is about. It's about taking those calculated risks, and it is about pushing outside of your comfort zone. I mean, even today, I still have fears about everything I do, but I
Yeah.
don't let those consume my thought process, my business plan, my operations, my strategy. I'm aware of them, and any entrepreneur should have some amount of fear, but I don't think that it should take over or run or rule you or your day.
And for some people that I'm sure for you that probably fueled you, whatever that you're scared of, it allows you to go into more deeper due diligence and et cetera, making sure that all the T's are crossed.
Yeah, absolutely.
And so that's very interesting. I think that's really great for our listener to hear, which is like, hey, there's that safety net for us. Maybe it take years to quit your job if you have to replace that income, have kids and etc. to supply, or if your other half, you don't all have to quit turkey. If your other half is set up, really you should kind of free up your mind and pursue what feels right for you for this. So tell us a little bit about the first year of operation. You just get started. I'm guessing what, if you don't mind me asking, what is the investment business that your parents has been kind of doing? Is it kind of along the same line?
Yeah, so, well, not in multifamily. And my parents actually never took outside investor dollars. They did everything through their own portfolio and their own leverage. And, they were investing too for the 2007, 2008 crash, right? Like, so it was a little bit different. Today, my parents both retired early from the real estate portfolio, and they've actually divested from all of their holdings, and now all of their holdings are invested with me. So it's now one and the same, but on the residential side, they did not do multifamily, but they did like large scale residential investing.
Gotcha. So that's very interesting. So you're comfortable with kind of the residential, even though multifamily, it's also still providing housing for people to live. So it's kind of like a step up, or like a bigger brother of the single family thing. So that kind of probably laid the brick of the foundation for you.
Yeah, I think what was interesting is in 2012, when I left the corporate world, I actually had a very solid footing on obviously the residential side because I grew up in that business. And my parents were really big on involving us in everything business oriented from the time we were little. Like, I remember it being so boring, but my parents exposed us to it. And I'm so grateful today that they did. But at the time I was like, oh, and I'm an old baby, so there were no like iPads and stuff to keep us busy back then.
Yeah.
But so I had the residential experience, but then working in various commercial operations, I also got a lot of exposure to the commercial side because my entire portfolio there was on the commercial side. So I actually came into my own business having enough information, I think, about both to really probably do either. And so even today, I mean, I just don't do anything single family. I just sold one of my last, I have a couple still, but one of my last single families, and just so I don't have to deal with something at that size because I'm at scale now, and it's quite frankly, it's too expensive to manage one-off deals.
Right, exactly. And so how is that first year gone through? So it sounds like you have leveraged your job to kind of figure out the mechanism and et cetera, and kind of grow into having your own practice. It's almost very much similar to a doctor, being in residency at the hospital and then work their way up and then eventually have their own practice.
Yeah.
So that's a very great to kind of step into. Tell us a little bit more about your first deal. Like, what did you do like in your first year or first 6 months or whatever it is to land to that first deal?
Yeah. So back then I was doing residential. So I didn't leave and go straight to multifamily. I actually started in residential, like a lot of people probably listening did or are planning to do. So my first deal was I actually still own it to this day. I bought a little condo in DC. And my thought there was to kind of replicate a portion of what my mom's business model was, which when she started, we would live in the house for 2 out of the 5 years so that we could take advantage of some of the capital gains tax advantages. And so that was initially the plan. It did not go like that, which that's, I think, the first rule I really learned is nothing ever goes the way you think it's going to go. And so, but yeah, so that was the first deal that I bought. And I initially started investing with our own capital. I didn't actually take in investor dollars at the onset. And so I started investing in like the single family space, started buying assets in DC. We ultimately relocated to Dallas within about a year. I think in 2013, we moved here to Dallas. So at the end of 2013, I started acquiring here in the Dallas area pretty significantly. But again, when you're buying residential, and anybody who's either made the switch or who's looking to scale will understand that it's hard to scale buying one house at a time. You have to buy either many at a time, which it's hard to source that many good deals, or you have to move to commercial assets.
Yeah. So you were still acquiring single family when you moved to Dallas. When you first started, you were doing single family.
Yes.
And I'm guessing it's kind of some sort of volume flip, volume hold.
Yes.
Buy and hold, or is it?
Yeah. So again, I initially started with the idea of doing like your typical fix and flip, but I was getting access to such good financing terms and it didn't really make sense for me to offload them. So what I ultimately started doing was I started doing like the BRRRR strategy. So buy, rehab, refinance, and rent, or I don't know which order the R's go in. Yeah. And so that's what I actually started doing. So I had that portfolio. I mean, I was buying, I'm trying to think, I think one of my busiest weeks, I think I bought like 4 houses in a week. Wow. Or 5 houses in a week. Yeah, it was a lot, and it was hard to manage that kind of volume.
Yeah. And then you must have a system and process kind of in place to do. Yeah.
Yeah.
And so, what about the first employees or significant employees that you hire, whether it's a 1099 or a first W employees that you hire that you think could really kind of help you accelerate it?
I think this is actually still true today, the same as it was back when I first onboarded somebody, and that's having a admin or like a support staff, because it's much easier to offload those like lower touch point activities. So for example, like managing my calendar, sending out follow-up emails. Being a gatekeeper has been huge, especially now. I didn't really need it back then because like no one wanted to talk to me back then. It's become more crucial to have someone who can kind of prioritize my calendar, who understands kind of what I'm looking for and what I need.
Mm-hmm. And what do you think for our listeners over here kind of thinking about taking on a system? Obviously, you need to let go. I still don't have exactly the same person. Just like, what? You're checking my email? Where should you look for these folks? And what kind of skill sets are you kind of honing in to make hire is the right one?
It's hard to find the right fit. I've tried virtual assistants that come from like overseas because it's more cost effective. The challenge I found with them is you need to really have somebody who just has like these 5 tasks and it's all they do, and it's replicable throughout the business model. Right. The challenge you run into is when you need to have someone who can critically think and then make deviations or adjustments to the standard. Mm-hmm. So what I've actually realized is what you really want to look for is someone who has project management experience, not an admin, because the admin tasks are easy. Like anyone can manage a calendar or email inbox. We really want someone who can manage a project or who can manage multiple projects at once and who can stay organized and can put in SOPs. So actually, one of the best tricks that I have is I don't necessarily only hire people with real estate experience, because sometimes if you're trained or you worked at some of the really big shops, you just have really good experience and you can reapply that knowledge into this field. So I had hired somebody previously on a 1099 from Disney. Oh. And she was phenomenal. She was really amazing. And she was so organized and she intuitively understood what I needed. And then now I'm the admin that I work with. Her background is in project management. She's not a real estate project manager though. And she's just been phenomenal. And she's really good about knowing and understanding and preempting, quite honestly, my needs. But giving up control is the struggle. It's still a struggle for me, as much as I love her and trust her.
Yeah, because entrepreneurs will always like to control where we're going. Great. So when did you make the transition from the flip to the multifamily?
Oh, that was about 2021. Sorry, it feels like last year was like an additional 10 years of my life in 2020. But yeah, so about 7 or 8 years ago.
Mm-hmm. Gotcha. So pretty soon, I guess based on the calculations over there, it's like you probably did your flip business for about 2-3 years, and then that's kind of where you realized that where the skill up is and got into it. Mm-hmm. So what is that transition like? Did you kind of, just like how you transition between your job, you kind of quit cold turkey on the flips and then jumped in?
It was not that easy because now it was my own business. You can't just like up and leave. So it was, let's see, I still owned a lot of the properties that I kept up until earlier this year, actually, was when I offloaded the last Dallas one. So I still had them, was still managing them. But again, it took too much of my time. I had to narrow my focus. So I didn't just up and leave the single family world, but I stopped acquiring more in the single family world. Mm-hmm.
Gotcha. And then when you're doing your single family, did you have investors from these single family projects, or all just your own funds?
All my own funds. Yeah. And actually, that's how I started in raising capital. I had friends approach us and be like, "Oh, I'd love for you to teach me what you're doing on the weekends." And I was like, "No, busy neurosurgeon that works 100 hours a week I can't teach you how to do this on the weekends. It's a full-time job. I work 100 hours a week.
Right.
And so then it became, okay, well, can I just give you my money? And then wherever you put your money, just put my money in with you.
Yeah.
And so that was actually like how that started. And I reached out to our SEC attorney and kind of went through what that actually formally looked like. And that was actually how we started there was no plan at the onset to take in investor funds.
Gotcha. And is your first multifamily also funded by your own money? Like,
No. That was funded by syndicated funds.
got it. So when you're doing the single family, there are people who are interested in investing, and then you kind of look into it. It kind of paved again. I start to see a theme here. It's like a paved the way for the next venture. So you have the ideas and et cetera, and then the people, resources, the money are in the same place.
Exactly.
And then that's kind of where that happened. So what does your first multifamily deal look like, and your involvement there?
Yeah, so it was just under 200 units here in the Dallas market. We were buying at a hot time, I thought, and today the market has just gotten hotter and hotter and hotter. And
Right.
I mean, even 3 months ago, I was like, okay, well, it's gonna like start cooling down, meaning I didn't think it was gonna like drop, but I thought it was gonna either like stabilize, or maybe instead of going like this, it was gonna be a little bit more of a flat curve. And it has just been on fire. And so we were buying in a hot market. In hindsight, it wasn't as hot as it is today, but I'm where I really shine and what I really enjoy in my business even today is really on the investor relations side, the capital strategy, capital stack, on the finance side, which is more my background too, but it's where I really enjoy being. So
Yeah.
I try to always touch that part of my business.
Yeah, definitely. So it's probably in some sort of roles and kind of bring the capital, get involved in the first multifamily deals, about 200 units and et cetera, and kind of bring some repeat from there. So you probably had partners back then,
Mhm.
that you also worked with the Enzo family, being one of the founding members there, probably pairing up with someone maybe is more the back office, doing the operations and et cetera. When you first started, did you try it out to try to see if there's multiple partnerships and then kind of pare it down, or was it more like, hey, you're my person, and then that's like the way it goes?
Yeah, that's interesting because I did not try out multiple partnerships at that time. It was you're my person, let's go. So we can just tell everybody that fun fact, you and I actually share a birthday. Uh,
Yes.
so we're both Leos and I am loyal to a fault. So it just, for me, it would have been uncomfortable to step outside of the partnership that I had already, been building toward. So we structured actually like pretty differently than I think most companies do in our space. And in hindsight, I mean, I think at the time it worked really well. But now I do understand why there's another preferred structure. And really it's because when you're in this type of space and you have partners that have to like sign on loans or they're investing their own money, you may not share the same investment strategy over a very long period of time. And you might not though. And so what was I saying? Over a long period of time, it may work out, it may not work out. So having the ability to be a little bit more flexible about how you're structuring your deal definitely makes sense. And it allows each partner then to have a little bit more control.
Yeah, got it. So you would recommend to say, okay, instead, because I'm always curious about that. There's two models I've seen most frequently working in this. One is a per deal structure, and then the other is kind of like setting up the LLC. It's basically saying, hey, whatever that we make moving forward, it's like this is the split through all throughout the deals. So because you're essentially a partner of the LLC,
Yeah.
which then controls the property. So you would recommend when you first started, perhaps working on like per deal type of a structure, maybe a better, just to kind of fill it out, and then as you kind of grow, you may get into the more the permanent structure.
Actually, no, it's not. Well, let me put it this way.
Yeah.
If it works out, it works out and it's great, which it did for me. Like I had a very strong partnership when I first started, which was very helpful.
Yeah.
I still have strong partnerships today, but now I have a little bit more control and I have a little bit more agility about what I put my name. I have a little, and I'm a control freak, right? Like we already kind of established that at the onset.
The other thing
So for me,
yes.
exactly. So for me, the way I see it now is having Vibe where I can make investment decisions. I can still work with any of the partners that I want to, but it's more on a deal by deal basis. And that way, if things are in my, like, let's say they're in my buy box, but they're not in one of my historical partners' buy box, I'm not forcing them to do a deal that they don't want to do or vice versa, right? And so for me, that flexibility and that control is really important.
Yeah.
So if I could go back knowing what I know today, I could have actually done it either way and probably still ended up happy and fine. But I think just with enough foresight to know and understand what was coming down the pike, it would have made sense to just be like JV partners more than setting up a single entity and doing deals across it. But I will say there's a lot of pros to setting it up the way we did that you don't get in a single deal structure.
Yeah, because that gives you more the acting as in the benefits of the investors.
Yes.
To use your judgment to say, okay, perhaps not all the deals and etc. my partner brought to the thing fits the box. So you know what to select. Yeah, that makes a lot of sense. So first deal you did was 200 units. And that I'm assuming it's probably going to be like, back then it's probably about 10 million, 15 million or so.
Slightly higher.
Because it depends on the classes as well. So then how did you kind of over the time, grow your followings and etc. So that you have more and more people kind of invest with you up to a point where you now have to say like, no, we can't take you, have to turn investors away on the single deals or, funding. Yeah.
Yeah. So I think I have a lot of referrals from my current investors. I am somebody who likes to build relationships. It's something I enjoy. It's something I excel at. So I think just creating those solid relationships has been really important. And also just, the more deals you do, the more people, get an opportunity to talk about what you're doing and tell their friends and their family. So we've grown organically. I recently have launched a masterclass, which is designed for passive investors, to kind of teach them how to look at deals, because the reality is how do you know if assumptions are aggressive or conservative? So it's called the Multifamily Masterclass. I know it's like a very creative name, but it's just mfmasterclass.com. You can check it out. It has over 90 videos. And I think it's the only course that is designed by active sponsors for passive investors. There's a lot of programs out there that'll teach you how to actively invest, but there's not a whole lot that'll guide you through making passive investment decisions or how to even look at those deals or ask the right questions or vet a sponsor. So that's kind of what that goal is on that. It's like a 6-week masterclass. And so that's another way I've had a lot of investors. I've had a lot of people approach me about deals, transacting deals through the MF Masterclass. And I also have, through social media, I've networked and met other sponsors like yourself. And it's really been all organic for me for the most part.
That's amazing. And the referral usually comes to good sponsors. If deal don't do well, obviously it goes the other way. So you don't want to be in that.
And I think too, part of being a sponsor, especially when like COVID hit, and it really put all of us in a position where we were like, all right, let's buckle up and brace because we don't know what's about to happen. Because it was so sudden. It was almost overnight that everything kind of like changed, right? And so I think communicating with investors was really important.
So what did you do during the COVID? Obviously probably definitely stand out because how you handle crisis and help you stand out, among the others.
Yeah. So I actually started doing a asset wide for each investor For any assets that weren't performing to where we wanted them, or anywhere where we saw any kind of uncertainty or instability, maybe our collections dropped a little, maybe our vacancy went up. Maybe we are seeing one of our assets, we saw a slight negative rent growth in that market. So any of those types of assets, we immediately put out a conference call. So I increased investor communication. I have one asset that really struggled through COVID. The tenant base just couldn't sustain not having a paycheck. And so we would talk about, here's what's happening, here's where we are, here's what we're doing about it, here's what we're seeing in the market, compare it to other assets. We would benchmark it to other similar assets. So investors kind of understood where it was operating. And I mean, our main goal in any investment we do at any time is to protect investor principal first. After that, we want to generate a return, and then we want to generate a higher than expected return. But I think that having that increased communication was really helpful for our investors. It's one of the things I really like about being able to control everything at Vive is I get to decide when, how often, and where I can be making communication. Because I think in hindsight, one of the mistakes I made was not actually starting that process as soon as I knew I should have. So I knew I should have done it. And, when you're one of multiple partners, you can't just make decisions that the whole
you want to make sure cohesively everybody communicating the same way.
Exactly.
So people like, oh, so and so like said this, like what's going on with this? Like that creates mistrust with the investor.
Exactly. And so that was a challenge because understandably, when you're operating assets, it feels vulnerable to say, hey, this is what's happening. And we didn't have any definitive answers. We didn't know what was going to happen. We didn't know if there was going to be an eviction moratorium at that time. And what I realized today, and I would have done differently and will be doing differently at Vive, is I'm going to communicate like, hey, doing this call to share with you the update. And the reality is we just don't know. And I think that's an acceptable position to have when nobody knows. It's not like I could call up my mom who's been through multiple down markets, be like, hey mom, last time there was a global pandemic, what did you do? Like it wasn't
yes.
Right. And so that was kind of one of the things I wish I would have done a little bit differently and done a little bit better. But I also think the mark of being a good entrepreneur is learning from those mistakes and constantly reevaluating what you could have done differently or better.
Right. Absolutely. Yeah. That was going to be my follow-up question, which is like the process and et cetera that you put in place is a learning from COVID. Because I actually also personally agree that COVID is a great learning opportunity for us to just become stronger and grittier operators on these multifamily.
Totally.
Yeah.
I mean, and we adjusted our underwriting immediately. So like the last two assets that we went into, which are really the only two we've done after COVID, we adjusted our underwriting significantly. We were using negative NOI from where the T12 was. So we were taking where the asset was performing through COVID and brought it down even further. Because at that time, we didn't know if there was going to be, another wave. There was no vaccine out.
Right.
And we had just put an $80 million deal under contract, and we had to make sure that our investors were protected.
Yeah, that makes sense. That's awesome. And you mentioned you kind of allude to that you invest in multiple different markets. How do you kind of determine what are the markets that you want to invest in, and how many markets are invested in right now? And can you kind of get into a little bit detail, because you're in these markets, you know these very well. Like, do you have some suggestions on these markets?
Yeah. So I put a map up and then I just throw a dart and wherever. No, I'm just kidding. No. I study markets that we invest into before an investor ever sees them. We've been looking at that market for at least 12 months, more closer to 2 years though.
Yeah.
And that's because I simply think that you have to know the nuances of every market in order to really be invested in that. So right now our focus right now is Atlanta, the North Carolinas and South Carolinas. It's basically where everybody else in the whole entire world is investing. So Georgia, North Carolina, South Carolina, Texas, Florida, Arizona, and hesitantly or potentially, I should say, Vegas. And right now, my portfolio is in just Texas, Florida, and Georgia. I've been trying to acquire in the Carolinas with no luck. I've been trying to acquire in Arizona with no luck. So, and it seems like Atlanta is the city that keeps working out for us and calling our names. So, but it's been a great city. It's been doing really well through COVID. It was one of 3 cities that had higher post-COVID rents than pre-COVID back in like September of last year, so a year ago, which was great.
Yeah, that's awesome. Obviously, a lot of market research kind of goes into there. Can you kind of give us a little bit idea, like take a behind the scene look at the operations that you have set up right now with your business? Because at the scale where it's at, like how do you find time, for example, for your family and the kids and etc. Like it requires you to potentially set up a system for your company. So what does that kind of look like today?
I mean, I don't find time. I'm trying to be better. But again, it goes back to releasing control. So now, some of the things that I try to automate as much as possible now. So if an investor wants to set up a call, they're direct. Like if they send me an email or like an intro, they automatically get a response with, "Hey, we're so excited to talk to you. Please visit vivefunds.com, click on the portal link, sign up," and they sign up in our portal. And then there's a scheduling link in there that they can schedule with me. I also have, I was telling you earlier, like anytime I'm doing podcasts or speaking engagements or anything like that, I am streamlining it to be on the same day of the week. I also block my calendar every single day from 5:30 to 7:30, which is like the time I spend with my kids.
Yeah.
I have twin toddlers.
In the evenings, right? Because in the morning, yeah. Okay.
Oh yeah, no, they better be asleep then at 5:30 in the morning. Yeah. And then I go back to work after they sleep oftentimes, and it ebbs and flows. It gets hectic when we're about to be under contract until we close a deal. And then it kind of slows down a little bit, but we have a lot of really good systems in place that kind of help us track everything. They help us communicate more efficiently. We cut down on back and forth as much as possible. And we set up SOPs for everything we do now, which we didn't used to do.
And how do you, can you give an example of things that you have improved to cut down the back and forth? I'm sure there's, folks that are interested too.
Yeah. So now we have, we utilize Dropbox, we utilize Google Drive, which I'm sure a lot of teams do. But one of the things we do is we utilize like a master spreadsheet when we're tracking distributions and returns. So we have a spreadsheet that we can look at that tells us exactly how much we've distributed, whether we're on track to meet pro forma. If we're off track, are we positive or negative variance? If we are, why? And all of that kind of gets loaded in our SOP. It gets loaded into there. And then that's something that we can use to make more strategic decisions. And that way we don't have to, get on a call every week and talk about like, hey, we're off by this much. We can all see it. And if we start getting off course, that's when we can get on a call or course correct. So it'll trigger the next action item. But I think it's been very useful for us to be able to do that.
Yeah, definitely. So communication tools within the teams and collaborations and system process sheets. Yeah, that makes sense. Great, awesome. And so we're wrapping our show over here. And Veena, actually, we would love to kind of have your link and information about how people contact you towards the end of the show over here in the masterclass for the passive investors. But last question we always have is, you have 2 kids, yeah, and today, and I think twins too, which is up to you. So how are you setting up? How are you kind of helping them to become financially literate, or apt to investment as you kind of upbringing, like as part of their upbringing?
Yeah, so I have twin 2-year-old daughters, so they're still really young. They don't really understand like the whole concept of money or personal finance, but they already have investment accounts, they already have their IRA accounts, they already have their savings accounts set up. So my parents from a very young age started teaching us and talking about this stuff. But I actually even now let them attend any internal meetings we have that aren't like external or with clients. They come with me. They sit on my lap. They know mama's working. They don't know what I'm saying. They don't know what it means. But they know mama's working. And like the other day, my older twin, she took her little like plastic laptop computer and she sat down and she was like looking at it, like typing like so intently. And she was like, I sit down, I working hard. And I'm like, good, baby, you do have to work hard. Good job. And so, I try to instill that subtly in them. They're still young, but I will have them, as soon as they're able to understand me, I'll have them start doing tasks within the business itself, just like my parents did.
Yeah, that's amazing. And then what is a Vibe Fund or Veena Jetti is going to be in 5 years or
Oh,
whatever the midterm is? Yeah.
yeah, let's see, in 5 years, I always thought I would like cut back, but I really think that I just really love what I do, that I don't want to cut back right now. So for right now, we'll continue growing. We've grown pretty exponentially in the last 12 months, and I hope to continue doubling volume every year for our AUM. In the last 12 months, we did 160 million in
Nice.
transactions. So yeah, I want to kind of keep that trajectory up and double that in the next 12 months, maybe do 300 million and keep growing that.
Yeah.
And, have in the next 5 years, I want a happy, healthy family. And, my kids will probably be in school at that point, assuming we go out into the real world sometime soon. That would be great. So yeah, that's where I think I'll be.
That's amazing. Well, thank you so much, Veena. And lastly, how does people contact you and where do they find the masterclass you mentioned before?
Yeah, absolutely. So you can go to mfmasterclass.com, which is like multifamily masterclass. So mfmasterclass.com. We're actually getting ready to launch our next segment or next course. And would love to have any new investors in there. It's actually designed too as a 101 and a 201 course. So it's for the new investor that doesn't know anything. And it's also for someone who's done a few deals and just wants to understand how to better invest. And then to reach out to me at Vive, you can go to vivefunds.com, VIVEFUNDS.com. Like I said earlier, I have an investor portal, so you can log in there. You can check out our current offerings if there are any, and you can check out any of our videos or conference calls that we have there too.
Perfect. And then we'll put that in our show notes. Thank you so much for your time today, Veena. And it was a great pleasure to always talk to you.
Yes, thank you so much.